Here we are at the end of chapter 4, completing the accounting cycle. This is part 3 of chapter 4, completing the accounting cycle. We begin this video with learning objective 4.5, describe the accounting cycle. So what is the accounting cycle? Well, the accounting cycle is a process by which companies produce their financial statements for a specific period. It is the steps that are followed throughout the time period. It starts with the beginning asset, liability, and owner's equity account balances left over from the preceding period. Here you see an exhibit F4-8. It outlines the complete accounting cycle of Smart Touch Learning and every other business. Now you start with step 1 and then you move clockwise. So accounting takes place at 2 different times. One during the period, which is step 1 through 3, step 1, 2, 3, okay, where you're journalizing transactions and posting to the accounts. And then the end of the period, which is 4 through 10, you're adjusting the accounts, preparing the financial statements, and closing the accounts. Here we are, learning objective 4.6. Use the current ratio to evaluate business performance. So how do we use the current ratio to evaluate business performance? Well, the current ratio measures a company's ability to pay its current liabilities with its current assets. A company prefers to have a high current ratio. And the reason for that is because that means it has plenty of current assets to pay its current liabilities. So a strong current ratio is 1.5, which indicates that the business has $1.50 in current assets for every $1 in current liabilities. So a current ratio of 1.00 is considered low and somewhat risky. The current ratio has decreased from 2018 to 2019. Now, this indicates that Kohl's Corporation has deteriorated in its ability to pay its current debts. Now, given that the current ratio is above 1.5 for both years, Kohl's Corporation would be considered a less risky investment than other business with a lower current ratio. Similarly, creditors would be more willing to extend credit to Kohl's Corporation than another company with a lower current ratio. So here's the company Kohl's with their total current assets and their current liabilities. Okay, of course, this is in millions. On 2018, February 3rd, 2018, the current asset was over 5, but in 2019, it decreased. 2018, liabilities was at 2.7. And here you see the liabilities have increased. So the current ratio as of February 2nd, 2019, the formula is you divide the current assets by the current liabilities, which will give you the current ratio of 1.77. The current ratio as of February 3rd, 2018, is actually 1.99. Now we are at learning objective 4.7. Explain the purpose of journalize and post reversing entries. Reversing entries. What are reversing entries? Normally, when we record accruals, we record an expense, revenue, and a corresponding payable and or receivable. In the next period, when a payment is made or received, the cash flow is recorded. The payable or the receivable is satisfied, and the difference is shown as an additional expense or revenue. Now, this requires referring back to the original accruals from the previous period. This process is inconvenient and potentially time-consuming. Later, when the cash flow related to the accrual finally occurs, the full amount of the cash flow is recorded to the related expense or revenue account. So reversing entries are special journal entries that ease the burden of accounting for transaction in a later period. It is not required by GAAP. It is used for convenience and to save time. And it's the opposite of adjusting entries. Here we see Smart Touch Learning makes an adjusting entry at December 31st to show it still owes its employees an additional $1,200 for the last half of the month. So to record accrued salaries of $1,200, Smart Touch Learning recorded the following adjusting entry. You see here there's a debit to salary expense and a credit to salaries payable. Okay. After posting, you see that the salaries payable account, and then you see the salaries expense account. This is after posting. The $4,800 debit balance of the salary expense is closed at December 31st with a debit to an income summary and a credit to salaries expense. After posting the closing entry, salary expense has a zero balance. This is after posting the closing entry. Salary expense will have a zero balance. Accounting without a reversing entry. Assume that Smart Touch Learning will pay its employees the second half of December salaries along with the first half of January on January 15th of the next year. So on January 15th, the company would record the following journal entry. They would debit salaries payable, debit salaries expense, and credit cash for $2,400. Now, this method of recording the cash payment is correct. However, it wastes time because the business must refer back to December 31st adjustments. Otherwise, the business does not know the amount of the debit to salaries payable. In this example, the $1,200. So searching December's adjusting entries wastes time and money. So to save time, accountants can use reversing entries. A reversing entry switches the debit and the credit of a previous entry. It is exactly the opposite of a prior adjusting entry. The reversing entry is dated the first day of the new period. Again, the reversing entry is dated the first day of a new period. It is the exact opposite of the adjusting entry. Ordinarily, the accountant who makes the adjusting entries will also prepare reversing entries at the same time. Smart Touch Learning dates the reversing entry as of January 1st so that it affects only the new period. The arrow between the T account shows the transfer of the $1,200 from the salaries payable to salaries expense. The $1,200, the reversing entry. This credit in salaries expense does not mean that the entity has negative salaries expense, as you might think. Instead, the odd credit balance in the salaries expense account is merely a temporary result of the reversing entry. Salary expense has a debit balance of $1,200, which is correct and represents only the January salaries. The payment of salaries covered two periods. $1,200 related to 2024 and $1,200 related to 2025. So the salaries expense account should only contain the amount that relates to 2025. Okay, so this is the end of chapter 4, the accounting cycle process. This is the end of chapter 4, the accounting cycle. Please watch out for the next video, beginning with chapter 5.